Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Aac Technologies Holdings Inc. latest report. Aac Technologies Holdings Inc. is a diversified company that provides various products and services across multiple industries. The company operates through several segments, including acoustics product, electromagnetic drives and precision mechanics, optics products, sensor and semiconductor products, and others. The company's product offerings include acoustic solutions for consumer electronics such as smartphones, laptops, earphones, and smartwatches. It also manufactures haptic solutions used in gaming, music, video, and virtual reality applications. Additionally, Aac Technologies provides precision mechanics, including structures for smart device casing, optical lenses, camera modules, and voice coil motor products. The company's product portfolio extends to micro-electromechanical systems, MEMS, microphones and technology solutions for consumer electronics, automotive, smart wearables, robotics, IoT, and other domains. Furthermore, Aac Technologies offers research and development services, manufactures tooling and precision components, electronic components, and related accessories, as well as provides electroplating services. In addition to its product offerings, the company engages in investment activities. With a presence in Greater China, the United States, Europe, other Asian countries, and internationally, Aac Technologies Holdings Inc. has established itself as a global player in the industry. Aac Technologies Holdings Inc. market capitalization of $39 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Aac Technologies Holdings Inc. holds a significant advantage in their industry. Aac Technologies Holdings Inc. trades at a lower price-to-earnings ratio of 17 times and a higher price-to-book ratio of 1.52 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 50% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company are multifaceted and varied across different business segments. Artificial intelligence advancements have been a significant contributor to revenue growth, as has the expansion into emerging fields leveraging core technology platforms. The leadership in AI-driven sensing and interactions has also played a crucial role. In addition, robust operating cash inflows and innovation in consumer electronics industry have contributed to revenue growth. Market share gain in optics business, mass production of periscope modules and OIS modules, shipments exceeding 10 million units for hybrid lenses and microprism products, and growth in automotive acoustics business through vertical integration are also notable drivers. Furthermore, the upgrade cycle in sensors and semiconductor (SSC) business has led to revenue growth. Emerging sectors such as heat dissipation have delivered rapid growth, while continued improvements in the profitability of the optics business and expanding contribution from higher margin segments have also contributed. The company's ability to optimize product mix and leverage vertically integrated capabilities has also driven revenue growth. Breakthroughs in shipment volumes for wafer-level glass, WLG, applications and gains in market share for X-axis linear motors, large-scale adoption of innovative side buttons and VC in key customers' models are other notable drivers. In terms of acquisitions, the company's acquisition of Hubei First Light, PSG Group, and PSS Group have also contributed to revenue growth. The pro forma information suggests that had these acquisitions been completed on 1 January 2025, revenue for the year ended 31 December 2025 would have been significantly higher. On the other hand, the primary drivers of revenue decline are limited. Acoustics products revenue decreased by RMB 75,391. Optics products revenue decreased by RMB 35,289. Sensor and semiconductor products revenue decreased by RMB 21,638. And other products revenue decreased by RMB 5361. Net income experienced a significant increase of 39.8% in 2025 compared to the previous year, reaching RMB 12.51 billion. This growth was also reflected in the year-over-year (YoY) comparison, with net income rising by 14.5%. The improvement in net income can be attributed to various factors, including enhanced profitability in the optics business and higher margin segments. Profit margins also saw a notable increase, with net profit margin expanding by 1.3 percentage points, PPTS, in 2025 compared to 2024. However, gross margin remained relatively stable at 22.1% YoY, indicating that the company's cost structure has not significantly changed. A notable exception was seen in the electromagnetic drives and precision mechanics segment, where gross margin improved by 1.2 PPTS YoY to 24.5%. The stability of gross profit margin at 22.1% suggests that the company's pricing power and efficiency have been maintained. The reasons behind these changes can be attributed to improvements in optics business profitability and higher margin segments. Additionally, a one-off fair value gain on contingent consideration payables contributed to the increase in net income. These factors collectively contributed to the notable growth in net income and profit margins in 2025. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. The net cash from operating activities has increased by RMB 1,980 million from 2024 to 2025, reaching RMB 7,183 million. This substantial increase suggests that the company is becoming more efficient in managing its day-to-day activities and generating revenue. The positive trend in operating cash flow is a crucial indicator of a company's financial health. It implies that the business is capable of covering its expenses and investing in growth initiatives without relying on external funding. The significant jump in net cash from operating activities also indicates that the company's management has successfully implemented strategies to improve operational efficiency, leading to increased profitability. Overall, the data suggests that the company is generating positive operating cash flow, which is a key indicator of financial stability and sustainability. This trend bodes well for the company's future prospects and provides confidence in its ability to continue delivering strong results. The company's debt level has undergone significant changes over time. While unsecured notes and total debt saw a decrease of RMB 79 million and RMB 364,018 respectively, the overall debt level actually increased due to an increase in bank loans and lease liabilities. This inconsistency highlights the complexity of the company's financial situation. In terms of interest expenses, there is evidence of both decreases and increases. Finance costs decreased by 5.3% from RMB 417 million to RMB 395 million on one page, while interest expenses increased from RMB 371 million to RMB 382 million on another. However, it appears that the mix of fixed and floating rate debts has led to a significant change in interest expenses overall. Overall, the company's debt level and interest expenses have changed significantly over time, with no clear trend emerging from the inconsistent information provided. The company's performance varied across different segments and regions. On the positive side, the acoustics business showed a revenue increase of 1.7% year-over-year, YoY, while the automotive acoustics business experienced a significant surge in revenue, up by 16.1%. Additionally, certain product categories such as electromagnetic drives and precision mechanics saw a notable rise in revenue, up by 19% from 2024. In terms of specific regions or products, the automotive and consumer acoustics products segment recorded an impressive growth rate of 28% from 2024. However, not all segments performed equally well. The acoustics business and automotive acoustics business experienced a decline in gross margin, down by 2.6 and 1 percentage points YoY respectively. On the other hand, some segments struggled significantly. Sensor and semiconductor products saw a substantial drop in revenue, down by 78% from 2024, while other products plummeted by an alarming 229% from 2024. These underperforming segments pose a challenge for the company to address and improve its overall performance. Management is emphasizing a long-term approach to the company's strategy. This focus on long-term growth is evident in their investment decisions, which are made with the intention of realizing performance potential over an extended period. The use of hedging instruments also suggests a cautious approach to managing risk and minimizing exposure to market fluctuations. In addition to this, management is prioritizing transparency, accountability, and independence within the company. This commitment to good governance practices underscores their dedication to responsible decision-making and sustainable growth. By taking a long-term view and prioritizing sound business practices, management aims to position the company for continued success in the future. The company has a history of rewarding its shareholders through dividend payments and share buybacks. In terms of dividends, the company has paid out RMB 164 million in 2024 and has proposed a final dividend of HK $0.35 per share for FY 2025. This demonstrates the company's commitment to returning value to its investors. In addition to paying dividends, the company has also engaged in share buybacks. In 2024, the company purchased 2,700,000 shares, and as at 31 December 2025, it held a total of 11,819,000 shares. This strategic move allows the company to reduce its outstanding share count and potentially boost earnings per share for existing shareholders. Concerns about inventory buildup and supply chain disruption are valid based on recent data. The company's inventory has seen a significant increase, rising by RMB 0.59 billion. This surge is also reflected in the inventory turnover days, which have increased from approximately 60 to 62 days. Furthermore, the cost of goods sold has risen by RMB 3,514,843, indicating potential inefficiencies in the supply chain. The allowance for inventories net has decreased from 2024 to 2025, and the cost of inventories recognized as expense has increased during the same period. These changes suggest that the company may be struggling with inventory management, potentially leading to stockpiling and associated costs. The accumulation of these issues raises concerns about the long-term sustainability of the supply chain and the potential for future disruptions. That concludes the financial summary for Aac Technologies Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.